I just recently finalized a trade that secured a massive 10% gain, bringing in a significant profit that has bolstered my portfolio tremendously. You might wonder how I anticipated this upward move. It was all thanks to identifying this specific candlestick pattern right here. In this video, I'm going to reveal my favorite candlestick patterns, the very ones I rely on daily to interpret charts and predict market direction. By mastering these, you can become a far more successful trader and execute high-profit plays just like the one I just finished. Let's dive straight into the details. The engulfing candle. One of my absolute favorite and most frequently used patterns is the engulfing candle. I've featured it in many of my tutorials because it is incredibly potent. This specific candle is so strong because it can pinpoint the exact moment a price reversal is likely to begin. But what exactly is an engulfing candlestick? The name essentially explains the concept. It is a candle in the opposite color of the previous one that physically engulfs it. A bullish engulfing candle opens at or below the previous candle's close and finishes above its open. Essentially, it is larger than the preceding candle on both ends, making it appear as though it has swallowed the previous price action. Trading the engulfing pattern. Let's look at an example. Here we've identified a very strong support level where price has bounced multiple times, proving the market respects this zone. As price returns to this support, we might expect another bounce, but we need more than an assumption before entering a trade. That is when we spot a bullish engulfing candle. It completely covers the previous red candle right at the support line. This is an intensely bullish signal, giving us the confidence that the price is headed upward. We enter the trade, and as you can see, the move follows through perfectly. A word of caution. It is vital to remember that just because you see an engulfing candle, bullish or bearish, it doesn't guarantee a reversal every single time. You should never trade based solely on a single candlestick pattern. Instead, treat these patterns as hints or clues about the market's next move, rather than absolute decision makers. Always combine these patterns with other technical tools, such as support and resistance levels, indicators, and broader trading strategies. To be clear, a pattern indicates a high probability of a move in a certain direction, but it is not a 100% certainty. The bearish engulfing now, let's examine a bearish engulfing example. We have a similar setup, a strong resistance level that the price has respected multiple times in the past. As the price climbs back to this level, it begins to lose steam, and a bearish engulfing candle forms, completely swallowing the previous green candle. This rejection at resistance, combined with the engulfing signal, serves as a fantastic indicator to open a short position. And look at the result. The price drops significantly. The momentum candle. Next, we have the momentum candle, which is much easier to identify than the engulfing pattern simply because of its sheer size. A momentum candle is a single bar that is 2 to 3 times larger than the candles immediately preceding it. This candle is exceptionally powerful because, once it appears, the price usually continues to trend in that direction, making it an excellent entry signal. The most effective way to utilize this pattern is within choppy or sideways markets where the price has been moving horizontally. Why momentum works. If you witness a sideways market followed by a massive momentum candle, 2 to 3 times the size of the previous ones, you can be fairly certain the price will continue that breakout. Think of it this way. In a sideways market, many short sellers are trapped in their positions, waiting for a direction. They often set their stop losses just above the resistance. When a sudden surge hits that liquidation zone, all those stop losses are triggered, acting as fuel that drives the price even higher. The same logic applies to shorts. If a huge red candle breaks out of a sideways range, it's a strong signal to go short as the downward move is likely to persist. Multiple candlestick wicks. Next up is the multiple candlestick pattern. This is one of my personal favorites because it tends to be very reliable and easy to spot. This pattern occurs when you see 3 or more consecutive candles with long wicks pointing in one direction. The more candles, the better. I prefer to pair this with key support and resistance levels. Look at this chart. What do you see? We have a key support level, and then we see multiple candles with downward wicks touching that exact line. Interpreting the wicks. These downward wicks tell us a story. Sellers are desperately trying to break the support, but buyers are fighting them off and winning every time. This repeated failure to break lower confirms the strength of the support and suggests a high probability of an upward bounce. Conversely, in a short example, if price reaches resistance and multiple candles show upward wicks, it indicates the market is unwilling to move higher. This provides a solid short entry. We enter the trade expecting a reversal, and the price falls exactly as anticipated. The doji candle next. We have the doji candle. A doji is characterized by a very thin body with wicks on both sides. Understanding this candle is crucial because it is a premier indicator of an impending price reversal. A doji represents total market uncertainty. The bulls and bears are in a stalemate, and the market is experiencing resistance to its current path. Whenever you see this kind of indecision, the price will more often than not begin heading in the opposite direction. Confirming the doji. Let's look at an example. The price is trending down sharply when a green doji appears. This tells us that sellers are losing their conviction and buyers are beginning to step in, marking a potential entry point. However, my personal rule with dojis is to wait for confirmation. I wait for 2 more candles of the same color to ensure the reversal is real. In this case, after the green doji, 2 more green candles move upward. That is my signal to enter and the price takes off from there. Doji variations. There are several variations of the doji you should recognize. The regular doji is what we just discussed. The long-legged doji is similar but features much larger wicks, showing even greater volatility. The dragonfly doji has a small body at the top with a long bottom wick, while the gravestone doji has a small body at the bottom with a long upper wick. Despite their different looks, they all tell the same story. A likely reversal in price is coming. The hammer and shooting star. The next candle we'll examine is the hammer. This candle features a decent-sized body at the top and a very long lower wick. This tells us that while sellers managed to push the price down significantly, buyers absorbed all that pressure and drove the price back up. This is an extremely bullish signal, suggesting the market will continue higher. Similarly, the shooting star is essentially an inverted hammer with a long upper wick. If you see a shooting star at the top of a move, it's a strong sign that the price is about to reverse downward. The tweezer pattern. The next pattern is known as the tweezer. This involves a red candle followed immediately by a green candle, both having nearly identical wicks at the bottom. If you spot this pair at a support level, it's a strong indication that an upward move is imminent. For example, as the price hits support, we see a red candle with a bottom wick, followed by a green candle with a matching wick. This proves the support is holding and momentum is shifting upward. For a bearish signal, you simply look for the opposite. 2 candles with matching wicks at the top, tweezer tops. The Marubozu candle. The final pattern I want to discuss is the Marubozu. A bullish Marubozu is a large green candle with absolutely no wicks, essentially a solid green rectangle. This is a great indicator that the price will continue in its current direction. You'll often find these in the middle of a trend, confirming that the move has plenty of strength left. In a Marubozu, the low is the open and the high is the close, meaning buyers maintain complete control from start to finish. The bearish Marubozu is the same concept but in red, signaling that sellers are in total command and the price is likely to keep falling. Bonus tip. Automation. As a thank you for watching until the end, here is a bonus tip. While you should try to memorize these patterns, I know it can be difficult to spot them in real time. Fortunately, there is a way to have your charts identify these patterns for you automatically. On TradingView, go to the Indicators tab and simply type the name of the pattern you want, such as bullish engulfing. Click it, and the platform will highlight exactly where that pattern occurs on your chart. You can even add multiple patterns at once, making them incredibly easy to spot without having to search too hard. Final thoughts. I hope you found immense value in this breakdown and learned something new. If you did, please take 5 seconds to like this video. The only real challenge with candlestick patterns is the false breakout, where a pattern forms, but the price does the exact opposite of what's expected. If you want to learn how to avoid those traps, watch my next video where I reveal my secret strategy for dodging false breakouts. Thanks for watching, and I'll see you in the next one.